Welcome to this explainer. Today we're diving into a massive perspective shift, something that completely flips traditional investing on its head by changing how we look at time and yield. If you've ever felt like the usual wealth building strategies are just, testing your patience, well, you're in the right place. We're unpacking a fascinating presentation that suggests the secret to beating the market isn't about finding some magical unicorn asset. Actually, it's about changing the velocity of your returns. So, 1% a month. Sounds incredibly small at first glance, doesn't it? I mean, we're so conditioned by financial media to constantly chase these huge double-digit home runs. But as you'll see, the source material makes it pretty bulletproof case that this tiny, seemingly insignificant little fraction, it actually beats almost every so-called safe bet on the planet when applied correctly.
Section 1. Reality check. Let's look at what safe actually pays. Okay, so look at these standard traditional returns. We're talking everything from your basic savings account sitting at maybe 1 to 4%, all the way up through government bonds, corporate bonds, and even the S&P 500's historical average of 8 to 10%. But here is the massive catch they all share. They are all calculated on a year-by-year basis. You literally have to park your capital and sit on your hands for 365 days just to realize these single-digit gains. And this is exactly where the source material asks us to completely flip our mindset. Forget the yearly waiting game played by megabanks and pension plans. Ask yourself, what if your capital compounded every 30 days instead? That's the core of monthly compounding. You calculate and add your returns to your principal balance on a tight 30-day cycle. It's like a snowball rolling down a hill, but picking up speed and size way, way faster because your money starts making money for you almost immediately. To really show us the raw math behind this, the presentation maps out 3 specific escalating scenarios. And notice, we aren't talking about wild, unpredictable spikes here. We are looking at consistent, targeted goals of 1, 2, and 3% per month. Let's see what actually happens to your money in each of these setups.
Section 2, the scenarios. Let's break down the math.
All right, scenario 1. The math shows that targeting just 1% a month snowballs into roughly a 12.68% compounded annual return. Just let that sink in for a second. The presentation points out that this 12.68% safely beats your bank, it crushes government bonds, and it easily clears most pension fund targets. 1 single percent every 30 days just totally outpaces the traditional retail finance system we just talked about. Now watch what happens when we double it to 2% a month. Suddenly, you're looking at approximately 26.8% compounded annually. Boom. At this level, you're not even in the retail space anymore. You have officially entered the institutional game. A near 27% return? That rivals strong years from massive hedge funds or top-tier private equity cycles. That is serious, heavy-hitting growth, just from a 2% monthly shift. And then there's scenario 3, 3% a month. At this rate, you hit about 42.6% compounded annually. The source is crystal clear on this point. This is an elite tier metric globally. Full stop. It actually outpaces even top decile venture capital funds. And the real kicker? It claims to do all this without the decade-long capital lockups or the gut-wrenching volatility that usually comes with those ultra-high net worth investments. This illustrates the exponential power of that math over a 5-year stretch. Imagine you start with $100,000 and you don't touch it. No withdrawals. You get 3 vastly different realities. At 1% a month, you grow that to $181,000. Not bad, right? But at 2%, you hit nearly $293,000. And at 3%, your capital absolutely explodes to $466,000. Your entire financial trajectory changes completely, depending entirely on that tiny monthly percentage shift. Section 3, the mechanics. Which brings us to the obvious question. If these numbers are real, why don't traditional banks just do this? Well, it comes down to a fundamentally different set of rules. Traditional finance is built on slow capital appreciation. Their whole game is buy and hold, right? They sit around waiting for asset prices to slowly drift upward over decades. Plus, they're bogged down by massive regulation and huge overhead. Active strategies are a totally different animal. They focus on trading volatility over very, very short cycles. They aren't waiting 10 years for an asset to go up. They're executing structured, calculated trades right in the moment. I absolutely love this quote from the source because it just hits the nail on the head regarding this mindset shift. It says, the same volatility traditional funds fear is the raw material being harvested. Think about that. Instead of panicking when the market dips or swings,
Active execution models actually use that volatility as their main ingredient. To them, a fluctuating market isn't a danger zone. It's literally the engine driving their strategy. So to sum up the core findings here, shifting your brain from yearly weighting to monthly compounding totally rewrites what's possible for your returns. 1% a month beats your retail bank, 2% a month beats the big institutions, and 3% a month, that puts you squarely in elite global financial territory. Which brings us to the very end of the source material, where it drops a pretty fascinating cliffhanger. It explicitly introduces something called Smartbot as the actual engine driving these exact yields. It really leaves us wondering, doesn't it? How exactly can automated algorithms execute these rapid volatility harvesting cycles in the real world? Can software truly and reliably turn market fear into compounding monthly wealth? That's a provocative question about the future of active trading and automation. Thanks for joining me for this explainer. Keep asking those great questions, and I'll see you next time.